Hi, everybody. Our normal host, Imogen Bachra, is out on vacation this week, so I'll be running the show. Welcome to Bondcast. As a reminder, this is a podcast series where we discuss our views on the latest themes and events shaping rates markets. I'm John Briggs, the Global Head of Desk Strategy. Today, I'm joined by our Global Market Specialists, Giles Gale, Jan Nevruzi, and Theo Chapsalis. Before getting into the discussion today, I wanted to quickly remind you to hit the subscribe button so you can listen to our latest episodes as soon as they're available. And if you have any questions for our Bondcasters, please reach out either directly or email the team at bondcast@natwest.com. We're going to kick it off right away by hitting up Theo. We had the Bank of England meeting. This is being recorded on Thursday, so note it's before payrolls, but after the Bank of England meeting. What's our takeaway, Theo?
It's definitely been a much more exciting meeting that many of us, us included, have been expecting, simply because we got a lot more information. We got a lot of more information when it comes to the nature of tightening to be delivered. We know that the marginal tool of tightening will be the bank rate. We know that the BOE intends to deliver, some sort of balance sheet reduction once we hit the 0.5% in the bank rate. And there is also an intention to deliver, to have active selling of QE, of QE held bonds, which is big after that rate reaches 1%. So it has been definitely quite an interesting meeting from that point of view. But it is difficult to digest it, not digest it, to dissect it and really understand what is the clear market trade. This is why what I find very interesting is a significant amount of intraday volatility. So even after having the news, it was very difficult for the market to understand what are we doing with that additional source of information.
So what is our market views? Have you changed your opinion on, either the front end or further out the curve based on the information we got from the Bank of England?
Yeah, I mean, we maintained the short bias of the 10-year part of the curve. We did have a tactical expression through a short and five-year yield. This is something that we maintain. We close, however, a 3-stance Sonia steepener, which is a slightly different expression. So get it very straight. The point is that there is no clear pushback by the BOE with regards to the amount of tightening that is priced at the front end of the curve. So to the extent that we don't have the pushback, then, well, more tightening can be priced in. And the other point is that I feel that a lot of investors did have steepeners and still have some form of steepeners. So I would like to reduce them, at least this type of steepener, and especially because in August, I don't want to run too much short-dated risk. So this is the one. The other thing which is very interesting is my take out of all this is that because of the way of balance sheet reduction, also hikes will be more difficult to happen once we reach that 0.5% level. So what does it mean in terms of markets? Well, I do think that the market will try to see the BOE as being, an absorber of volatility. And still, if they see that after a non-reinvestment of gilt, that there is, a significant sell-off in rates, that you just push back with regards to more tightening. So the ability of the bank rates to move substantially higher after we've reached 0.5% is probably reduced, given that some form of tightening will be delivered through this balance sheet reduction.
Yeah, so that's what my last question is about, which is the path of quantitative tightening. Let's say, once we get to 50 basis points, the bank signaled. I mean, what is, if that happens, call it, 2023, which looks like is probably, in the window of when that might occur, maybe late 2022, but we'll see. When they start doing that passive rundown, what kind of redemption sizes are we looking at? Is that going to have a big impact, do you think, or in the near years, is it pretty limited?
I think it is. It depends on the year. And when we look at the financial year 2021-22, so the current financial year, we've got 63 billion of QE redemptions. This is a high number. We talk about total redemptions in the area of around 95 billion. So having 63 that are part of QE is quite a significant number, given that is reinvested. In the next financial year, we will have only 9 billion of QE redemptions and 107 billion of non-QE redemptions. So yes, it makes a difference in the next year. Now, you can say that either you reinvest or you don't reinvest in the next financial year. Well, that's not a big issue. Anyway, what is an issue is that you will not have the support from QE reinvestments. But where it does become an issue is if we look at years such as 2024, 2025, which are years when you would expect a reinvestment flow of QE holdings in the area of around 60-ish billion. So if that does not happen, and we have gilt redemptions that are north of 100 billion, well, I guess this is quite significant in terms of tightening. So it does matter, not necessarily for this financial year, but if this is delivered, it is definitely very hawkish for a few years later down the line.
Got it. Okay, thanks. Well, on the subject of central banks, I'm going to hit over towards the U.S. next with Jan Nevruzi. And actually, got two questions. First is, we had some comments from Clarida yesterday that looked like the market took a little bit hawkishly because we were heading lower in yield until, he took that out. So any thoughts there? And then on the flip side, which is on the Treasury side, on the issuance side, we know the Fed's coming up to near-term window on tapering, or announcing tapering at some point. We think we're going to get more information on that in September. But on the issuance side, did we learn anything from the refunding? So two questions there, one on the monetary policy side, one on the Treasury issuance side.
Yeah, sure. Starting off with Clarida's comments. There was definitely some to unpack there. It's undoubtedly on the hawkish side of the rhetoric that we've been hearing. It kind of adds a little bit more towards this buildup of hawkish speeches that we've been hearing from FOMC members, and I think it underlines the kind of the risk management aspect of towards more persistent inflation and how their approach might change with respect to their new Fed framework. To me, all this points towards more hawkish rhetoric in the upcoming months, the more focus on risk management, and perhaps even more push towards getting on with tapering to not necessarily, not tightening, but get towards the path of normalization in track. He was saying that he thinks by the end of 2022, we're going to have conditions ready for hikes. He expects one of those to for us to start hiking in early 2023, which pretty much implies that he's ready to go with tapering. So I think it adds a little bit more to the hawkish rhetoric. Doesn't necessarily change the path that we as a team have been seeing, but I think it just kind of reinforces that there's definitely more inflation uncertainty, and that the FOMC members are acknowledging that as well. On the refunding, I guess the August one was not extremely sort of insightful in the sense that we didn't get any changes as we expected to. They pretty much said that they're going to keep the coupon sizes unchanged. However, now November is in play. That has been our base case so far too. We did expect for cuts to be announced in November. The Treasury didn't really give any details on which tenors will be cut, but the Treasury Borrowing Advisory Committee, they discussed a little bit, and the recommendation was more for the 7-year and the 20-year part. Our view is that they're going to overweight the 7-year and the 10-year, just given because of the sheer size that they brought back into the market with the whole pandemic response, and just a little bit on that. We understand why the concerns about the 20-year being there. Just since they brought the line. It has underperformed. It has underperformed compared to on any fly structure, asset swap structure. But if market at this point becomes convinced that if they reduce the issuance size of the 20s can help with the digestion problems, then it probably can. So at this point, it seems like for them to disappoint would be to not actually underweight the 20s of it going forward in issuance. Otherwise, nothing too surprising. We're going to see probably a little bit more in November. That's going to be when the real changes start happening. From Bill's side, I thought it was interesting that now they're going to discontinue the 6 weeks, the cash management bills. Of course, there's a lot of uncertainties now that we're in the debt ceiling period. So all these changes that whatever they have to adapt to the fiscal environment, they're going to have to do it in bill form, and namely the cash management bills are finely tuned for that purpose. The 6 weeks are gone after mid-August. The 17-week ones continue until at least through October. So we should see a lot of variations there, but all sorts of forecasts are going to be very short-term in nature anyways.
Okay, so you took me to my second question for you, which is debt ceiling. Do we see that as a risk, or we still think it's going to be okay?
Our view has been that it is a risk in the sense that at some point, as we get closer to September, we might see some repricing of front-end instruments around what we expect it to be towards end of October, when we think if the debt ceiling didn't get suspended or increased, then we expect for the Treasury to technically run out of cash about late October. So we would think that about that towards that point of the curve, we would see some like a little hump formation where real money type of institutional investors would want to stay away if there's any risk of technical defaults, even though it's a very, very tail risk, and we do not expect the Congress to let that happen. Our base case is for the debt ceiling issues to get resolved after the August recess in September. But markets could start pricing that in, particularly as we go past the summer lull, and people start reevaluating their portfolio holdings as the cash runs down.
Okay, cool. All right, Giles, I've been saving this for you. It's a question that we got in, and I'm glad I'm asking you and not having to answer it myself, which is, what do you think the primary factor to the recent move lower in global bond yields is?
Okay, I guess that the answer for me is just fear. I think that there's fear of that. There's kind of macro fear. There's concerns about COVID. We've been through a little bit earlier, perhaps in the UK and in Europe around the Delta variant. Compared to other developed markets, there's concern about that escaping to the US, to Asia, which has been largely saved from all of these problems. So, there's uncertainty surrounding all of that. There's uncertainty surrounding, the end of furlough, the end of things like debt moratoria and so on. So I think that is, if you're looking for the fundamental kind of story that's driving it, or that sparked it, perhaps, then that's that's the fear. But then there's fear which is just market fear, which is liquidity is low. It seems like every summer there seems to be some positions that are sought out and then pressured, and actually that seems like it's the whole process has just happened perhaps earlier in the summer than you might otherwise have expected in a normal year, and perhaps in a more broad-based kind of way as well. So I think that is the ultimate answer. It's different dimensions of fear. I will just say one other thing, though. I think that there's also potentially a kind of rebalancing sort of argument here, where risk assets have been doing really well. Earlier in the year, we were talking about perhaps an argument that that people ought to be investing less in fixed income because the correlations didn't look like they suggested you should have such a high allocation to fixed income in diversified portfolios. But after we had that big sell-off in the first part of the year, maybe people were looking at that and going, maybe we can reload on this and protect some of our gains in risk assets in a kind of macro fashion. So maybe that's been part of this kind of this rebalancing, the squeeze dynamic that we've seen so strongly over the last month.
Well, it's interesting because you had a pretty prescient call in late June, early July, which was to hibernate your bearish views over the summer, because you have a sense that there was a lot of potential, maybe not perhaps for this much of a squeeze, but potential for a lack of spur for European yields to go higher. Where are you now on your hibernating bearishness? Are you still in the cave, or are you starting to see some sunshine?
I think you've been a little bit generous. I don't think I ever said take it off. Just no, we were a little less aggressive, let's say. Going into July, I think we were expecting lower volatility Obviously, that hasn't happened. Thought that August might be, might be the time to get bearish again. I mean, that may well turn out to be true, but largely just because the levels have reset so dramatically. Listen, where am I? I don't think that now is the right time to be too aggressive about anything, just because it really does seem like the markets are still in this very sort of technically, this kind of positions seem to matter more than anything. And so someone like me I can have a strong macro view, and doesn't really matter potentially at the minute. So so I would say I'm still in the cave.
Okay, what about periphery? Last question there. Anything new on spreads?
Well, so listen, I mean, I think that I think that actually of all the various markets in Europe that you can maybe spreads are probably the most interesting. We've had this kind of macro squeeze, which is in a way left not all that many obvious dislocations and curves. I mean, we've had some interesting things going on in asset swap spreads. At the very long end, there's been some stress in ultra longs. But I think that the most interesting things are the way that we haven't seen spreads respond in the way that you normally would have expected in such a strong rally in rates overall. I mean, we've had lots and lots of discussions over the last months with investors about the risks to spreads at these sort of relatively tight levels. And one that always comes up is, if you're right about the bearish view, surely higher rates makes you more bearish on spreads as well. Well, conversely, lower rates should be good news for spreads. I mean, it makes debt sustainability better. It means there should be more yield grab and so on. And actually, I think everything stacks up as a story for spreads at the minute. I mean, politics are really nowhere on the risk radar at the minute in Europe. You've got really, really supportive sort of background flows, with quantitative easing. Everyone seems to expect an extension to PBP. And rates are just that much lower. So I think, and actually, just the last point, there's not a lot of evidence, I think, right at the minute that positioning is all that much of a problem in spreads either. So I think you've got a pretty strong story for periphery spreads over the next month or 6 weeks. Certainly, I think that's the one position I would have on with a fair degree of confidence at the moment.
Great. All right, well, that's it for this week. We got the employment report, which is coming out after this recording. So we'll see how that does for this ever push lower in yield. It seems to be happening in August. But if you like today's episode, please hit the like button to show your appreciation and click subscribe so you can listen to our latest episodes as soon as they're available. Just a reminder, if you'd like to pose a question to any of us, or particularly Giles, please reach out to us at Bondcast@natwest.com. Thanks again. We'll see you next week.